Hello and welcome to the presentation of a Type A reorganization. We're going to go over the definition of a Type A reorganization, some of the structures and the requirements to meet tax implications to the shareholders and the corporations, cases and revenue rulings covering Type A reorganizations, as some examples of recent corporations utilizing Type A reorganizations. Now, the term reorg refers to any corporate restructuring under Section 368 that is tax-free. Type A, in this case, is referring to statutory mergers and consolidations. Now, this reorganization follows the tax rules discussed in Treasury Regulation Section 13681. Now, a merger occurs when the acquiring corporation gives up some of their stock and other property in consideration for the target's assets and liabilities. Something that's a little bit disadvantageous here is that you have to accept all liabilities, contingent and unknown. Consolidation occurs when the corporations involved form a newly made corporation. All of the participating corporations' assets and liabilities are pooled into this new corporation. The involved corporations cease to exist, and the shareholders have stock and consideration from this corporation. The drop-down is similar to a regular merger, but in this case, the acquiring corporation will transfer all or some of its target's assets to their subsidiary. It is important to note that in order to qualify for a Type A reorg, you have to abide by state, federal, and foreign merger and consolidation laws, which could include something along the lines of 2/3 of all the shareholders and all corporations involved have to agree on this, and some dissenting shareholders may ask to appraise and buy out their stock. There is also some flexibility in the 60% of the other 60% of compensation, money, promissory notes, etc. Now, in the case of a forward triangular merger, the parent subsidiary the target will merge into this parent subsidiary. Now, the compensation given to the target cannot include the subsidiary's stock. In a reverse triangular merger, the subsidiary is going to merge into the target instead of the target merging into the subsidiary in a forward triangular merger, hence the term reverse. Now, in order to qualify for a reverse triangular merger, you still have to qualify for a Type A, but the largest difference is that the compensation has to be 80% voting stock of the acquirer, not the subsidiary. And the target must hold substantially all of the assets and liabilities of both the subsidiary and the target. Now let's go over some tax implications for the target corporation and the shareholders involved. The whole point of being able to set up your agreement in order to get a Type A reorg transaction is so the target corporation can relieve itself of the large tax implications from the gain realized on the exchange. So you think of the compensation plus the relieved liabilities minus the basis on their assets will be the gain realized, but the gain recognized will be zero. To shareholders, the gain to be recognized will be the lesser of the gain they realized on the transaction or the boot received, whether that be the money or promissory notes other than the stock and the consideration. Now, it's important to note that Section 356A2 offers a dividends deduction to qualifying compensation of cash. Now, let's go over some cases and revenue ruling. In the case of Norman Scott Incorporated versus Commissioner back in 1967, Norman Scott and his wife owned 99% of the stock in each of the participating corporations in this statutory merger. The statutory merger, he claimed, was under Section 368A Type A, so that Norman Scott Incorporated can deduct the net operating loss carryovers on its federal income tax return. IRS disputed that since the corporations were insolvent at the date of the transfer, they demonstrated no proprietary interest, but the court opposed this. So what's really significant about this case is how the IRS and the courts will evaluate the proprietary interests of each of the corporations involved in this reorg. On the case with King Enterprises Incorporated versus United States back in 1969, King Enterprises Incorporated was a shareholder of Tenco, and Tenco had merged into Minute Maid. Now, the compensation included voting stock of Minute Maid and promissory notes with cash. King Enterprises asserted that the cash and notes were subject to the Section 356 dividends deduction, but the courts were evaluating this transaction under the step transaction doctrine, which essentially brings out the significance of how courts are going to judge how each of these individual transactions leading up to the merger would be fruitless on their own, or if they all were a means of being able to constitute a Type A reorg. With Revenue Ruling 5893, this referring to a case in which the acquiring corporation cannot directly acquire the assets of the target, but will be able to through a wholly owned subsidiary. Now, what's important to take away from this is that although the target transfers its assets into the wholly owned subsidiary prior to merging with the acquired corporation, it has the same result as if the target merged right into the acquiring corporation. And that's 368 Section 368A2C supports this treatment as if the target merged into the acquiring corporation. Revenue Ruling 77307 refers to a case with a reverse triangular merger, and that the acquiring corporation gives cash to the subsidiary, so the subsidiary is able to compensate the target's dissenting shareholders and the majority shareholders that hold fractional shares. Now, what you could take away from this is that the reorganization plan would have not been disqualified for Type A reorganization treatment would sustain with the target corporation substantially holding all of the properties of the subsidiary and the target itself. The cash contributed did not become relevant in determining the substantially all requirement. Now let's quickly look at some current examples. So Verizon had acquired Vodafone in a sort of consolidation. Now, this consideration given was for the 45% stake Vodafone had in Verizon. Now, the consideration for this included a little over 1.27 billion in common shares to Vodafone shareholders, as well as a $6.6 billion cash compensation, which was derived from the term loan credit agreement. Now, for IBM's acquisition of Red Hat, this exchange included all Red Hat's issued and outstanding shares for an amount of $190 per share, totaling to approximately $34 billion in equity value. Now, you can't find the exact, they didn't publicly disclose the exact amount of the stock and the compensation, but Red Hat's former shareholders would have had the stock in combination with the cash. And that cash, if not subject to the Section 356 dividends deduction, would have been considered ordinary income or gain on their tax returns.